Hello to all of you. We are really pleased to welcome you for this session with Akur8. Thanks a lot for attending it remotely and spending time with us on the pricing topic today. For sure, we would have preferred to have this event face-to-face like last year. Indeed, it was our very last trip to London before lockdown in France, but it's good to see you and at least to have the opportunity to be with you today, even remotely. My name is Brune de Linares. I'm leading the sales and customer success for Akur8, and I am today with Félix.
Hi, everyone. My name is Félix, and I'm in charge of partnerships at Akur8. We're really pleased to present Akur8 as well as some insights on the topic of pricing. These are insights we've collected through our discussions with insurance companies over the world. But I'll first let Brune quickly recap who we are and what we're doing at Akur8.
Yes, thanks a lot. So we will spend 2 minutes on who we are and what we are doing. So we are a software company dedicated to insurance pricing, so really dedicated to that specific use case. We are based in Paris with offices in London and New York, but we are operating in a large number of markets. Indeed, it's one interesting element on the pricing is that even if the regulation can vary from one market to another one, the fundamental actuarial principle used to build your pricing are the same all over the world. So all actuaries are building similar type of models to predict the cost of a potential client. And in the most sophisticated markets is price elasticity. So from Japan to UK, we see different levels of sophistication, different market trends, trend on the prices and competition, on customer behaviors, but always the same methodologies. All teams are using the same kind of solution to build the same kind of models. The differentiation comes from the content of these models and the constraints followed by the modeler. And at Akur8, we developed a software as a service solution leveraging transparent AI. And we will come back on that later in the presentation. So leveraging transparent AI in order to empower your actuaries to build smarter models much faster. And let us come back in the coming slide on these two elements, smarter and faster. And let's start with speed. So definitely the current context leads to an unprecedented need for agility. Insurance companies have to protect their profitability and growth, particularly in an installed low interest rate environment, and so have to predict the risk and the demand as accurately as possible. But in a context in which customer behaviors are changing massively and frequently, this is a huge challenge. Indeed, we see that 86% of the European insurance company interviews in the study done by ESG consider they will face definitive changes in their customer behavior. If you're reading some studies from the Big Four on the customer behavior post-COVID, it's always interesting to read the introduction, like this one from KPMG. Given the magnitude of COVID-19, our understanding of markets and consumers are evolving in real time. Indeed, insurance companies are facing some changes in customer behaviors that impact the risk they represent and their conversion probability. We know the COVID crisis indeed had an impact on how people use their car, which is having an impact on their future claims and hence level of risk. Insurance companies already face a decrease in claims frequency, but an increase in the claim cost. And when we see on the Chinese market, for example, according to the Wall Street Journal, after lockdown, Chinese market faced a 10% year-to-year increase in car sales. In Paris, bicycle sales more than double after lockdown. So definitely new opportunity, we think, to capture for insurance companies, new mobility behavior, and so also risk behavior to understand. But the economic crisis has an impact also. The economic crisis has increased the price sensitivity of a certain number of profiles that were historically less sensitive to price. And this is just the beginning. So in that context, combined with an increasing pressure on price, you cannot take months to build models for your pricing strategy because they will be outdated when you put them in production. So you need to be up to date. And this leads definitely to a need for agility, but also for safety on how you are building your prices. And today, we see on the market different levels of sophistication on the pricing process. Let me give you a simplified vision of a pricing sophistication journey. So, first step consists in adjusting the price based on the past loss ratio. So no predictive modeling, but a manual adjustment based on the past. Second step of sophistication, risk-based pricing strategy. Because you are able to predict the cost of your customer, you can proactively build your prices based on each client's expected cost, and so avoid high loss ratio segments. What we see on the market with the different discussions that we have, we see that a kind of commoditization of this second step, risk-based pricing. So predicting the cost of your potential client is the best practice applied or to be applied in the near future for almost all insurance companies. And definitely and for sure for retail, but even progressing, we see that this is a topic that is progressing for SME, commercial, and even for specialty products. Third step in the sophistication journey, demand-based pricing. So on top of the cost, you predict your conversion demand to build prices that will help you to reach your business objective. Then you can move to the optimization, building your pricing strategy based on business requirements on profit and growth, and leveraging risk and demand predictive models. So of course, even if optimization is the final step of the sophistication, you need to have a strong and robust model both on risk and demand. Indeed, optimizing pricing based on weak predictive models will lead you to extremely expensive errors and absurd pricing decisions. And so we see an exposure for insurance companies to only focus on speed, sacrificing safety and robustness, and particularly when they model demand and need to understand price sensitivity of their potential customers. So at Akur8, we design our product based on that conviction. You need to combine speed and safety. But how do we bring speed in the pricing process? Let me spend 2 minutes on that. So what we are doing at Akur8 is that we are applying machine learning to automate the production of models that you can understand, that you can review, you can interact with. So for the actuaries in the room, I'm pretty sure that we have plenty of actuaries. We are automating GAM and GLM's creation. So this automation allows you to build models 10x faster and so bring speed and agility, keeping a full transparent output. And this is key for this specific use case, for the pricing use case, because it's a regulated industry. Black box effects are not acceptable. It's too risky for regulatory compliance and to avoid potential adverse selection. So you cannot have blind spot in your model or in your pricing strategy because it could lead to underprice some segment of the population. And this is the reason why we spend 5 years R&D to develop specific machine learning algorithm in order to automate modeling production, but keeping full transparency and control on the model created. We see in our conversation with different insurance carriers that indeed they tested black box model for risk, but consider black box effect and so lack of control unacceptable. It's a bit different for demand modeling. More insurers use black box model, but can't capture the price sensitivity. But at Akur8, we think that you can keep robustness without sacrificing speed, even for demand modeling. And now we suggest to spend time on robustness for demand modeling.
Thanks, Brune. Indeed, one important question for us is, what does robustness mean for demand modeling? When you attempt to model the demand of your customers, you need to predict two things: the conversion rate and the price sensitivity of your customers. And it's key to be able to predict these two effects independently. So the first effect, probability of conversion, this amounts to answering the question, will my customer buy my cover at the current price point? And to build a predictive model for conversion, insurers leverage customer profile data, past offered prices, also in some cases, competitor data. And this type of modeling is relatively straightforward. Classic machine learning or modeling techniques can be used, and the model's performance can be easily tested on historical quotes data. But then the second effect, price sensitivity, this amounts to answering the question, how does this probability of conversion evolve when I change my price for a type of customer? And to build a predictive model for sensitivity, insurers will need to leverage either price tests or price changes performed in the past. Let's take an example in motor insurance. So let's say an insurance company is trying to predict how its motor customers are going to react to a given price quote based on their customers' attributes. One attribute that's often looked at in insurance is the model of the car owned by the customer. And since we're French, let's go with Peugeot cars. The first question I'll have is, for customers who own a Peugeot, what's the probability that they will purchase my insurance cover at the current price point, say 90 euros per month? And how is the fact that they own a Peugeot impacting this probability to buy? So this is the probability of conversion. But you also need to estimate price sensitivity. So the second question becomes, if I increase my price by 1% for these customers, how strongly will the probability of conversion evolve? And how is the fact that they own a Peugeot impacting this price sensitivity? So these 2 points, probability of conversion and price sensitivity, could have different drivers and need to be modeled separately. And an attribute like the model of the car could influence the probability to buy, but influence the sensitivity to price in a different way. And so modeling these two effects is going to allow you to understand and interpret the behavior of customers who own a Peugeot car. So in our current example, the motor product could have a very high conversion rate on customers with Peugeots, perhaps because the brand is very strong with these types of customers. But the sensitivity to price could also be very high. And this means that even a small change in price is going to have a big effect on the conversion rate. And if you don't model this effect separately, you're going to capture the high conversion rates, but you can fail to understand the sensitivity. And so what could happen is that if you slightly increase your prices, encouraged by your high conversion rates, you'll actually lose way more customers than what you initially expected. And of course, you need to be able to understand these effects for all client attributes, not only the car model, but the location, the distribution channel, the driver age, etc. And that makes the process very complex and challenging. And so at Akur8, we were really convinced that there was no solution currently on the market that allowed insurance companies to address that challenge and implement a modeling process that was both robust and fast. And so in our solution, we have a unique process to build models with two distinct components, one to predict conversion rates and another to predict the impact of a price change. And this guarantees a robust modeling process. And we also leverage machine learning to increase the speed of the modeling. And that allows insurers to build dozens of models in minutes and leverage large volumes of quotes data, price tests, price changes, and also external competitive data. And so building and implementing this type of modeling process is really a huge challenge for insurance companies, and we see that in our conversations with them. But definitely having the right tools can help them simplify the process. And if they achieve this type of modeling and implement it correctly, it can have a huge impact on their ability to drive their portfolio strategy and their pricing strategy. And now let's focus a bit more on that, on pricing strategy. Say you understand your risk drivers, you've been able to build accurate conversion and sensitivity models, and you can update them really fast to keep up with the changing customer behaviors that Brune was discussing previously. That's all very good, but how do you use this to actually drive pricing decisions? Insurers need to be able to test and iterate on different pricing scenarios, and by playing with different scenarios, they can understand the impact on their business. So again, let's look at an example in motor insurance. If I'm an insurance company, I could be wondering, say, what I should do to grow my book of customers. Should I keep my prices stable? Should I perhaps decrease my prices because the market is getting more competitive? Or maybe should I increase my prices because I need to account for evolving risk profiles and behaviors. It's key to make that decision. It's key to be able to understand the effect of my pricing decision on both my GWP and my margin. And another tricky part is that, of course, the validity of these decisions are only as good as the underlying models. And with robust models, insurers can have a strong level of confidence in their pricing scenarios. But if your models are unreliable, then you increase the risk that your pricing decision is going to lead to unintended consequences. So here's an example of what could happen. Let's say you have a bad risk model. This can impact your profitability down the road because as unexpected claims come in, the profitability of your book is lowered. And a bad conversion model can impact your new business because your conversion rates are lower than what you'd modeled initially. So in your journey towards increasing your pricing sophistication, each step is really key: risk modeling, demand modeling, analyzing the impact, optimization, and really the fundamentals need to be mastered before moving on to each next level.
Thanks a lot, Félix. So always a challenge to present such a complex topic in only 15 to 20 minutes, but we hope that it was clear on the positioning and really the conviction that we have at Akur8. We would be happy to continue the discussion with your pricing team, with your chief of actuaries. Just I would like to mention that in our way to progress with our customer, we offer to test the solution for free, so you can challenge your current pricing strategy, the model that you are using, and potentially assess the value that you could get from a more sophisticated solution, or at least a different solution with Akur8. So really happy to open that discussion with your team. But I see that we have still a couple of minutes available, so maybe we can answer to one or two questions. One question that we have is related to the data that we could provide and competitive data that we could provide on the platform. Félix, can you maybe answer to that one?
Yeah, sure, I can take the question. That's definitely a question we're getting more and more. So at Akur8, what we strive to do is give insurers the right tools to properly leverage this type of data, this type of competitor data, which can be hugely valuable. So while we're just a software player, we do have partnerships with data providers in several different markets, the UK, France, Spain, Italy, to enable insurance companies to use competition data to better understand customer sensitivity to price. Because of course, the closer you are to your competitor's best price, then the higher the price sensitivity of your customers.
Thanks a lot, Félix. So another question related to the Akur8 references. So I will take that one. So yes, we have more than 20 customers that are using Akur8 in different markets. So in Colombia, in Japan, in Spain, France, Italy, Belgium, UK. So lots of markets. And I would say different type of customers. So we have some references like Generali France or AXA in Spain or in Italy that are using Akur8, but we also have references like Canopius in the UK on the specialty product. So different kind of insurance company, different level of sophistication, different markets. So now we are at the end of this session. Thank you very much for your time and your attention today, and really happy to open the discussion with you and your team.
Thank you very much, everyone.